You are listening to Fast Track Podcast, the place to be to fast track your personal finance or fast track your business, or both, through a series of conversations with those who have learned it, done it, and made it. Before starting the episode, I have very exciting news to share with you. I am collaborating with financial Imagineer Matthias Richter to launch the Fast Track Money course. This 6-week online course is designed to help young professionals in their 20s to early 40s to learn how to save more, earn more, and invest, using money as a tool to fulfill your dreams. We teach you the proven method that Matthias has been using himself in the last 20 years and achieved financial independence. So sign up today on fasttrack.live/money course to transform your relationship with money from today. Yasser is my guest for today's episode. He's a multi-asset portfolio manager managing billions at a large Wallstreet bank. He has a master's degree in finance and CFA designation, and he began his financial career in accounting and tax consulting. Afterwards, he worked for the Big Four companies and joined traineeship at Dutch insurance company, where he learned about insurance and mergers and acquisitions. After his traineeship, he worked at asset management department as a valuation and performance specialist, and eventually he got an opportunity to become a portfolio manager. And at the side, he has his own YouTube channel called The Money Principles, where he shared timeless principles about money and investing. The reason why he began teaching about money is that he noticed that a lot of people around him has many questions about investing, but he was not able to help them structurally. So he wanted to share his knowledge in a way that is accessible for everyone. And in today's episode, I'm very interested in his experience, and we talk about generational wealth, we talk about investing, and we talk about the myth that people have towards investing. So let's listen to this episode. Welcome to Fast Track Podcast, Yasser.
Thank you. Thank you for having me. Always a pleasure to meet other influencers.
Yeah, and for the information of the audience, if you are listening to this podcast, and then you saw the title, Chat with Yasser. Actually, in Dutch, his name is pronounced as Yasser, right?
Indeed, yeah.
So just let you know, it's still the same person. So today we're going to talk about a lot of things related to personal finance. And from my intro, you guys already know that Yasser had a YouTube channel teaching people about investing, money management. But today, let's start with the first question. Maybe can you tell us a little bit about yourself? What's your background? How did you get started into producing content about personal finance?
Yes, sure. But maybe indeed, let's start how I started my career and what my background is. So when I was about 16 years old, I wanted to become a businessman. I hadn't really had a clue what that meant, but I wanted to be a businessman. So I started, my bachelor's. I started in business economics. I wanted to learn about business. And I got the opportunity to work at 2 Big Four companies, PwC and Ernst & Young, as a tax consultant and in accountancy. And that's helped me to get some work experience, but also was, the first experience in, finance. I liked it, but it was not really the thing that I wanted to pursue. So I also continued my studies and I got a master's degree in finance. And that gave me also the opportunity to still be broad, not to focus on one specific specialty within finance, but to have multiple opportunities. And one opportunity that presented was a traineeship at an insurance company, a Dutch insurance company. And I was able to rotate and do different assignments within the insurance company. And one of them was mergers and acquisitions, which is one of the more prestigious, assignments. And that was very valuable. It was the first time that I thought, okay, this line of business is something that I'm really interested in. And that led to eventually getting into a permanent role at the asset manager of the company. And the asset manager, I was responsible for valuations of financial instruments, for instance, complex derivatives, but also private loans and also calculating the performance of what the portfolio managers were doing for their clients. So it was quite a diverse role, but in the end, I got an opportunity to get, let's say, some sort of promotion, but I was able to become a portfolio manager. And a portfolio manager is an investor, a professional investor, which is responsible for a certain part of the portfolio. I was focusing on corporate bonds, particularly what we call investment grade, so high quality corporate bonds, with a particular research focus of technology, media, and telecommunication. So I became a specialist. I also eventually moved into a more specific area called multi-asset investing, and I'm still a multi-asset investor. And if you're a multi-asset investor, your primary goal is what we call asset allocation. So you look at different asset classes, so equities, real estate, but also commodities, gold, oil, and bonds, government bonds, corporate bonds, and look at where are the opportunities and can you, let's say, efficiently allocate to that, create diversification in your portfolio, but also look at, okay, where are certain parts of the portfolio, how can you, let's say, direct your portfolio in such a way that you can optimize your return and lower your risk. So that's what I'm also currently doing. But during my, let's say, my journey as a professional, I got quite some questions from friends and family about investing, about what should I do? Should I buy a house? Is it time to buy a house? Are prices too high, too low? And of course, I wanted to help. Let's say my natural gift is teaching. So I wanted to teach people about that. But it was quite difficult to just give somebody advice on a random question. So I thought about, okay, is there a way that I can create a vehicle for the knowledge that I have to help other people? And I thought about writing a book, started with that, but I thought, okay, maybe, yeah, that will be for a particular group, but not everybody will read it. So maybe to do videos, maybe a podcast or something like that. And eventually I started my YouTube channel. My YouTube channel is called Money Principles. And the goal for the channel is to share timeless principles about money and investing, and to give people, let's say, the opportunity and also, let's say, lower the threshold to start investing, because there are many reasons why people don't invest or why people take too much risk in investing. And I wanted to give, let's say, people the tools to make better financial decisions. So that was, let's say, in short, my story. I had my YouTube channel now for about a year. I've been able to get some following, but I think the main goal is just to also, as a creative person, to express yourself and also to create something that I think adds value to friends, family, and anybody who wants to learn something about money. So
yeah, it's what you talked about earlier. It's so important that, some people, they think it's so difficult to start to invest. Something is like super scary for them, right? Or some people take unnecessary risk. Then it becomes like a gambling. And it's very important to educate oneself before just put all your money in the stock market or in some high risky financial vehicles. And now, from your experience, you have such a wide range of, let's say, financial experience. I can say that, like experience in financial market. Now, as a multi-asset portfolio manager, so from your personal point of view, how would you manage your money? So now we know that you know so many things. How would you, to manage your own money in a way?
That's a very good question. Now, the first thing that I've learned, and I'm also when you want to educate people about money, you start reading. I read about 30 books about personal finance. I also learned from that, because personal finance is somewhat different than, like, let's say, academic knowledge about finance. It's great to know how to, let's say, value a derivative, but that's not something that you're going to use in your personal life if you're not, let's say, in that business. So when I was learning about personal finance, I've learned to, let's say, combine the two worlds and to make, let's say, make the complex easier to understand. So if you want to be financially successful, there are two things that you need to have. You need to have an income strategy and you need to have a wealth strategy. An income strategy is all about, okay, how do you get your money? Do you start your own business? Do you want to build a career? Negotiating salaries, but also how to build a skill set that is valuable for the marketplace. When people talk about getting rich, sometimes they also talk about, oh, you need to start your own business, get wealthy via that. But that's more about creating an income strategy and not so much about creating a wealth strategy. Because a wealth strategy is more about what you do with your money. So how do you keep your money and how do you multiply your money? And of course, multiplication you do via investing. But the question is what do you do with your money? And one of the key things with financial success is that you have you're very goal-oriented. And you need to make sure that the steps that you take and the actions that you take contribute to the thing that you want to achieve. And not everybody has the same financial goals. Some people don't have financial goals. But the first thing that I would encourage people is to start thinking about them. What do you want to achieve? Do you want to become debt-free? Do you want to have financial security, have an emergency fund in place? Do you want to retire? Do you want to retire early? Do you want to maybe save to buy a house? So what are your financial goals? And if I look at my financial goals, and that's related to your question, is my financial goal is to build generational wealth. And the only way to build generational wealth is to create an investment vehicle that can live on its own, so to say. It's that it's not, let's say, the risk of going to zero so that you have a loss of capital, a loss of principal needs to be very, very low. So what I've done, I've created, let's say, an investment vehicle. It's a very simple investment vehicle, but it allows me to achieve my goal. And my goal is to build wealth via that vehicle and be able to help future generations. So my children, I have 2 young children, my grandchildren, but also it allows me to be generous with my money and to help other people with it. So that's let's say, one of my financial goals. But generational wealth can only be obtained if you also have, let's say, other levels of wealth in place. And because, of course, if you're still struggling to pay your bills, then let's say generational wealth feels a bit out of reach. Yeah. And so I also think that when you create your, let's say, financial goals, you need to understand the 3 levels of wealth.
So I have 2 questions on behalf of our audience. Maybe they have this question in mind as well. So question number 1, if you don't mind sharing, for example, for other families who also have children, now they, have extra cash for investment, how can they or learn from your example, just as a reference? Okay, here we don't do financial consultancy or financial advice, purely for reference. Then what would you do to create this, generational wealth investment vehicle? So that's question number 1. And question number 2 is what you mentioned earlier, what are the financial goals? So what are the typical financial goals that, an average person might have? And then please elaborate a little bit on that, how they can set, like say, a plan to achieve those. So those 2 questions.
Yeah, let me first start with the investment question. So when people, let's say, decide to invest, I see, let's say, 2 kinds of people. Either people don't invest because they're scared of it, or either people are so excited about investing, they go all in and they lose their shirt and they get discouraged. And you want to be in the middle. And one of the key things is that you need to understand your investment before you invest. Or, in other words, you need to invest your time first before you start investing. So let's say you think real estate is interesting. Then read some books about it. Start learning about real estate. Start learning about how it is to buy, let's say, residential real estate, how to create rental income, how to do maintenance, how to do the taxes, and then go into that. Because the answer of what should you buy depends all about what do you want to learn. Do you want to learn to invest in real estate? You can also buy, let's say, a passive real estate fund, so REITs, and so that's a real estate investment trust. If you can also buy that, you can do that passively, buy an ETF on that, but that still requires you to learn about it and to understand what you're buying and what you can expect from it. Because if you, let's say, invest, you also want to know what kind of return can you expect from it. And the only way to do that is to invest your time in that. And my preferred way to do it, because I'm a liquid markets guy, because that's my, let's say, my trade, I've decided to invest my money, or at least my generational fund is a equity fund, a full equity fund that is invested in a sustainable manner. So it, let's say, focuses its investments on industries that will probably be here for the next, let's say, 10, 20, 30, 50 to 100 years. So it avoids the stuff, especially the more dirty industries that might go extinct in a few years' time, given the green transitions that we're now seeing. So I've decided to do it via equities in a fund that is more sustainable. However, also with sustainable investing, you also need to know what the implications are, because it can also have some implications if you don't own certain industries, and what will happen to your portfolio and to the diversification of your portfolio. So it's not a clear-cut answer, but what we generally see, or my general advice is that if you don't want to spend significant amounts of time and start with equities, because that's the easiest and the most, let's say, understandable investment. You buy a piece of a big company, you will own part of that company. That company generates profits. Part of that profits they reinvest in that company. That will result into price increases, price appreciation, and a part of their profit they pay out in dividends, and you will get that. And then what you can do is reinvest your dividends to buy more stock. And over time, your nest egg or your fund will grow and grow, and you use the power of compound interest to build wealth.
Are you using dollar cost averaging just to fund the investment every single month? Or how are you going to pass it to your children in the future, or when you grow at a certain scale, or when they reach a certain age, you say, hey, kids, here are those lump sum of money that take it.
The thing, and that's with generational wealth, there are a few things. It's not just investing. It's not that you have a pile of money, because that can also just ruin your kids. So you need to have also specific goals attached to that fund. So what will that fund do for you? What will that fund do for your kids? And one of the things that what you see with wealthy people is they, for instance, have a family bank. So if your kid wants to buy a house, they can go to the family bank, they get a loan, and that they will still pay interest on that loan. They still need to repay that loan. But what they will know is that all the money that they will pay goes towards their children. So that the repayment of the loan and the interest will be reinvested and will grow over time. And that will allow their children to also buy a house. And the great thing, and then you think, okay, what's the difference between getting a loan from a bank and getting a loan from a family bank? Mathematically, it doesn't make a difference. But from a tax point of view, there are some benefits. For instance, you can still gift some money back. So you can you pay a certain interest and you get, let's say, a tax deduction on it. And then you can get, for instance, part of the money back via a gift. So you have a high tax deductible, but you don't pay a net interest that is still, let's say, the market, and that effectively lowers the amount that you need to pay. So first of all, there's a tax advantage, but more importantly, you're not in the bank system. I know that my children, if they pay, they also, of course, pay for their own future. So you know that all the money that I will put in is for my children. And that also, it creates, let's say, a peace of mind and something that you will be happy to pay your mortgage bill, because it will be something positive.
Yeah.
Instead of, I need to pay the bank.
Is it something viable to, like, I'll say, majority of people are, let's say, affluent investors, or it's very exclusive for like ultra high net worth families?
No, yeah, you can, because of course, if you have, let's say, if you are, let's say 35, and your children are still young, maybe they're 5 years old, and you know that they will need to buy a house when they're 25 or something. So you have 20 years to invest for that goal. Let's say you invest, and you will be able to, over that 20, let's say 100K, or maybe 50K, or even 20K. You can also do it they can also do, let's say, a dual version, that they get partly a mortgage from the bank and partly a mortgage from you. That still gives them the same benefits, of course, to a lesser extent than if you can give them a full loan. But the generational wealth is all about mindset. It's all about how you want to, let's say, let your money help other people, help your children, create a legacy, and also help people, let's say, outside of your family. So it's not just that some people just say, okay, I have a lot of money, I retire early. That's also an option that you have, but that's more a selfish option. Okay, this is just for me. But what if you can extend that, and what can you do with your money and create a legacy? But that doesn't exactly require a high net worth, but a high net worth helps with all financial goals.
This is a brilliant way of looking at creating generational wealth, I have to say, because in the other interviews I mentioned, we joke around what are the mistakes people made is the parents save a lot of money, or they invest money in a fund, and then the fund matured over 20 years or 25 years. And then they pass this money to their adult children, like, here you go, this is the money we invest for you. And then the adult children bought a brand new BMW. And I think
yeah, that's a kind of a waste, to be honest.
Yeah.
But they can, of course, but what's more important is that you educate your children along the way. So what goals that we have. So the family bank is one goal for generational fund. Another, let's say, goal of the fund could also be just education, is that you pay for education of your children. And one of the key things there is that particularly, that's also the reason why I started my YouTube channel. I have now something that I can show my children. Okay, how do you look at your spending? How do you look? Or do you already invest? When will I start teaching them about investing? It's probably when they're 10 years old, they will need to learn about investing, because they have a very long time horizon then, if they then start investing. But it's very important that they will learn also the basics of how can they manage money. And they need to learn about generosity, because generosity is kind of the missing link. Because if you only learn to use money for yourself, then indeed all your financial choices will be either buying stuff for yourself that will go down in value over time, and it will lead to a lot of waste. Well, if you can also teach your children about generosity, okay, you can help people, you can help yourself, your family, your children, but also strangers. How can you be good with money and be a blessing to your family, to your surroundings, to your community?
Yeah, that's I would like to give you a lot of thumbs up here, but this is the audio podcast, so audience, just let you know, I give Yasser a lot of thumbs up. I really love the philosophy that you have towards money. And now we talk about generational wealth, right? And also think about when you create wealth like giving. Let's trace back. Let's say someone who has not, had any children or is still very young. How would the person start to prepare the financial future? Let's say, what are the few levels of wealth they can, plan for their life?
Yeah, it's a very good question. So there are 3 levels of wealth. You have financial peace, financial independence, and generational wealth. Financial peace is all about being able to pay your bills. So being debt-free, not having payments, having an emergency fund in place in case an emergency happens. So your rainy day fund. It's also about retirement, because you don't want to, let's say, work 40 years, then don't have any income, fall into a gap and be poor when you're old. So it's also about saving for retirement. If you live in Europe, you're lucky because retirement investing is something that's mainly done via a corporate plan, and that's been done for you. So some people don't have to think about it, but I would encourage people to start think about it, because it does matter if you, for instance, switch jobs and your country, let's say your company first contributed, let's say 10% to your retirement, and then you switch job and your new company will do 5%, then that is significantly less. So I also encourage people in that stage to think about that, and also maybe look into ways to find additional or do something additional to fill that gap. But also to start thinking about giving. Normally people think that when you're rich, you need to be generous. But the misconception is, if you're not willing to give $10 out of $100, you will never be able to give 10 million out of 100 million. So you need to learn also the benefits of generosity. And so you can start small. And the good thing is, because the amount is low and anybody can do it. And also if your income is low, anybody can do it. And the great thing about giving is it detaches you from your money. So you don't fall in the trap of becoming too greedy or to becoming too cheap and not being able to enjoy your life in the process of becoming wealthy. So that's also an important tool. And then, so that's the first, let's say, level of wealth, is that you make sure that you have the things in order. You get out of debt, you create an emergency fund, make sure that you save for retirement, and that you have that you start learning how to be generous with your money. But with financial independence, the second level of wealth, it goes much deeper. First of all, what you want to do is that you want to, because you need to be intentional with your money, you also need to be very intentional with your spending. In the financial peace part, your spending, sometimes you need to be, especially if you're in debt, you need to be ruthless, and you need to be, you need to make sure that every dollar goes to the to the right thing. So you need to track your spending. You need to have a budget. However, in the financial independence step, it's also about making sure that you fully use the function of spending, because spending is not only making sure that you cover your cost of living, it's also about enjoying yourself. And especially people have different, what we call money dials, the things that they like spending money on. And in that stage, you also want to direct money towards that you more proactively budget fund money, and that you proactively budget things that you value, for instance, personal development, or the things that ticks you, or that makes you happy and that you get excited about. Also in financial independence, it's of course about saving. You need to not have just an emergency fund, but you also want to create more flexibility. So an emergency fund is about if something bad happens, you have money available. But if your if you want to be financially independent, let's say something bad happens, you kind of you fall back and you need to start working on your emergency fund again. That's the problem. So you want to create some additional funds. So we call it excess savings. And that excess savings has two purposes. First of all, it creates room, peace, in case something worse happens than just your refrigerator breaks. Let's say you lose your job. What if you lose your job? Can you live for a few months? But also, it will give you, and this is super important. This is the reason why most people who, for instance, follow FIRE get stressed when, for instance, the market goes down, is that you need to also have money available to chase investment opportunities. Because let's say the market goes down 50%, and your nest egg and your let's say your wealth building vehicle comes under pressure, why don't you have money available to buy something? And you think, okay, but if you just leave it in the market, it will give you a high return. So has a higher, let's say, financial benefit. But financial success is only 20% knowledge. It's 80% psychology. So you need to account for your own psychological, let's say, challenges. And one of the financial challenges that you will encounter is that you will be under stress when markets go down. Whether you understand markets, yes or no, the reality is if the market goes down, you do feel it. It does have a pain. But what if you can get a medicine for the pain? And that excess savings is a tool that gives you a medicine for the pain, because if you know that if the markets go down, you can buy more, then you're happy that the market goes down. So you reverse the psychology on, let's say, a negative event.
Yeah, and question on this one. Extra savings, how much extra savings would you recommend someone to have? Let's say this person already achieved financial independence and have extra savings, or have extra savings in order on the way to achieve financial independence?
This is a very good question, because if I look at wealthy families, what you see is that they have a golden rule for this. They have about 75% in liquid investments and 25% in savings. And you see that with billionaires, see that, let's say, with people who have 10 million or 1 million, they have about 75% in either equity, real estate, or whatever, and they have 25%, and that's a lot. So
cash, you mean?
Cash on the bank account. Maybe you can put it in a high interest rate investment account or a high interest rate savings account, but it's doing nothing.
If that exists nowadays, high interest rate savings account.
In Europe, it's not the right word for it, but no, but that cash does nothing. But the reality is that the risk of, let's say you have 4 million. Let's say you use an easy example. Then you have 3 million invested. So you already get a very serious return on that on a yearly basis, and you can easily live off that. So money is at that point not, let's say, the issue. What you want to do is create a system that is unbeatable. And you need to create layers of safety. And that excess savings you want to be, and that's the reason why you always see the headline, when there's a crisis, the rich got richer during the crisis. Why? Because they have this pile of cash. They can just move it in, let it generate money for a while, and then move it out again. And they can just enhance their returns massively on the back of that. So what I propose for people to do, because I think that at 25%, especially if you're just started, is maybe too much. But what you want to do is already create a system. So make sure that you don't just have your let's say, emergency fund in place, because maybe that's too little, but you already, let's say, I want to have 5,000 or 10,000 available in case the market moves against me, and also create a system around it. So one of the systems that I use, if the market goes down 10%, I buy a bit more. If the market goes down 20% from the peak, I do a bit more. So I have a bit of a system in place that if the market does something, I can react to it. And it doesn't make me smart or doesn't make me sophisticated. It just gives you the peace of mind that if something happens, you are prepared. And then, of course, when you start building wealth and serious wealth, then, of course, you can increase that. So what I always suggest is that if you manage your money, let's say you do a budget, then you have a certain amount that you want to give away every month, a certain amount that you want to spend every month, a certain amount that you want to invest every month, but also have a certain amount that you want to save every month. And that just goes to your cash. And yeah, the reality is money attracts money. You will find opportunities to make use of that money. Even if you want to, let's say, buy a house or maybe remodel your house, you have money available to do that. You don't need to go into debt. You don't need to live like a student. So you can also just enjoy it, but you have money available. And it already gives you the peace of mind.
Yeah, sorry, I have a question related to the medicine for the pain when the market dipped, right? How would you console someone? For example, if the market dipped and then the person buys in a little bit more, and then the market dipped again, and then there's no more cash left over to buy. So it's very difficult to manage this, the downward trend and keep buying in this investing pattern.
Yeah, so of course, reality is, let's say the market dips 10% and you put all your money in. Let's say you have that strategy in place. Every time it dips, you put everything in and then you save up again. And if it dips again, you put everything in. Because the market always eventually recovers and moves higher, especially if you use a diversified portfolio, then that 10%, you bought it 10% cheaper. And you were able to get, let's say, a return on that. So let's say you're worried about it dropping another, then cut it in half. Just do it at one piece at 10%, one piece at 20%. And of course, if you have more wealth, then you can also say, okay, let's do 10%, 20%, 30%. After 30%, it becomes a bit of a blur because the market doesn't go down 30% that much. So that will be maybe once every 5 to 10 years. So then be prepared to sit longer on your cash. But yeah, a correction of 10% is something that happens about every year. So you get an opportunity to invest your money every year. But if you do it, let's say -20, -30, that also means that you will have longer the time that it will not be used, and that you should also be happy with that. I personally don't. I'm fine with that. I'm happy to have, let's say, a bit more cash. I personally have about, I think, 30% in cash, about 66% in invested. But that also to do with, the states of life that I'm in, that I want to remodel my house or want to buy a car. I just have the money available. But yeah, it depends a bit on your, also on your goals and how flexible do you want to be.
Right. And this is very important point. And now thanks for clarifying it, is that so for investors who have this investment strategy in place, but have extra cash on the side, just only when the market dipped at a certain point, according to the strategy, they buy in, and then they filled up this extra cash pot again, right? So.
Yeah. So the 25-75%, let's say, allocation is, let's say, it's not static, or let's say it's a target ratio, but it's not, let's say, it could be that when you're let's say, see an opportunity that you're at 15 or 20%, but then you just fill it up, and that doesn't mean that you sell your investments. Could be, but I would not recommend it. Just leave that as is and let it grow over time. But you would just save more into it.
Yeah. Okay. Now it's very clear, because in the personal finance community and for a lot of average investors, what's recommended to do dollar cost averaging. So that's like you invest into an ETF or fund constantly every single month or every quarter. But this strategy can be used to reap the opportunities in the market when it dips. You have extra cash at the side. Yeah.
So I would always have part of my budget allocated to investing. So every month, indeed, invest your money and use dollar cost averaging, not for the sake of dollar cost averaging, but more for the sake of having a habit in place and making sure that you invest every month, because investing every month will allow you to achieve your financial goals. And this excess savings and using this excess savings is more for the psychological part, but also to, let's say, improve your returns. But it's not, let's say, you won't count on that excess savings to achieve your financial goal. A goal should be achieved with your monthly investments already. So it's more a return enhancer and also a peace of mind enhancer, instead of let's say, the tool that gets you to the goal.
Yeah.
And the reality, if you're financial, let's say, if you want to be, let's say, financially independent, the reality is that if you look at, for instance, your investing and the savings ratio in particular, because that's the most important driver of, let's say, your wealth accumulation, returns are important, but not so important as how much money you actually put into the market. And that savings ratio, that will determine how much wealth you can build over time. So whether you invest 10%, 15%, or 50%, or 80%. Maybe a good example is that if you, let's say, earn 50K a year, it doesn't really matter, because the savings ratio doesn't, let's say, is income independent. But let's say you are able to invest 80% of your income, then you could potentially retire in 5 years. That's let's say, the fast track fire, let's say, a solution. But if you do 50%, then it takes you about 15 to 20 years. So you need to figure out your financial independent goal. So how long do you want to take to become financially independent? And that depends per person on what they want to do. My personal goal is not to retire. I don't think that adds any value. I want to stay productive. I want to add value to my clients and create the stuff that I like via my YouTube channel. And I don't want to, so I don't have that goal. I don't want to retire. I do want to be financially independent. I want to have the funds available to create, let's say, the freedom. But I don't have, let's say, I don't have to per se do that in 5 years. That's not necessarily the goal. So I personally have, let's say, a savings ratio of 50%, which is still a lot.
Very high. Still very high, yeah.
It's still very high, but I do take into account all my retirement investing. And especially in the Netherlands, we have a very solid retirement system, and my company also saves for my retirement. So if I take everything together, it's about 50%. And next to that, I have my saving. So it's quite that can be quite a lot, but that's achievable for me at the moment. And yeah, I think that it depends a bit on what you want to achieve in that respect. So how, let's say, how long do you want to take to become financially independent? But way more important is that you understand that savings ratio is way more important than chasing exotic investments that potentially get a very high return. You see people spending a lot of time and energy on creating very complex portfolios, adding all kinds of risks to their portfolios that they have no clue about. And if they have a clue about it, then they need to spend a lot of time keeping up with their investments. So their return on their attention, that's how I call it, is not always that great. So, but the most important thing they tend to forget is that it's fine to have a very complex investment, but if you only invest $1,000 in it, even if it doubles in value, you have another $1,000, and it doesn't give you anywhere close to what we call financial independence. That's always talking about, let's say, at least $500,000 to $1 million. before you can call yourself financially independent. So I think that savings rate is something that you can focus on. And what's great is that if you have an income strategy in place, that can be a very good way to help your savings rate. Because if you have a certain lifestyle and you're able to double your income, then you can potentially save 50% more if you keep the same lifestyle. So if you have a good income strategy, 50% is not that difficult to achieve, but it does require your attention, and you need to be very intentional then.
Yeah, I think 50%, sounds a lot, maybe to a lot of people if they never pay attention to their spending. But if you really list all the items, one by one, and you see where you can improve, actually you can save a lot of money. Just do it once, improve it, and then next month you probably have like a several hundred, even 1,000 more. And then you can improve your savings rate slowly. That's a very interesting point, because you mentioned like savings rate is more important than chasing high return or high risky investment. Let's touch on the investment part. What are the other common mistakes or misconceptions people have towards investing, or through your, the questions your relatives or friends or audience ask you in the past?
Yeah, I think that the key mistake is that the moment people get familiar with investing, and they read a book about Warren Buffett, he makes, let's say, he had an average return of about 20% per year, or they read a book about Jim Simmons, who had an average return of about 60% per year, making it, let's say, the best investor. He's a day trader, so why shouldn't I get into day trading? But they take an example of somebody who's the best of the best in a certain category, and then they're going to apply it to themselves. And then the reality is that it's very difficult to replicate, let's say, such a strategy. And there's also a cost of trying to replicate such a strategy. One of the costs could be just financial ruin. You try something, you're not good at it, and you get discouraged by your own mistakes. That's a risk, and then you don't invest anymore. You're not able to build wealth. But also the problem is, let's say you are successful with it. Let's say you get a very high return on your investment. What then? Do you continue to do the thing that you do? So let's say you found an altcoin that was very successful. Do you continue to invest in that altcoin? Do you invest all your money? Do you start to rebalance every month? Adding those complexities require you to spend more time on it. But if you spend more time on it, then the question is, what is the opportunity cost of that? Of you spending less time on something else. So for instance, having a side business, become an entrepreneur if you want to do that. So there is also a cost of your attention. And are you aware of that? And I think that's something that most investors tend to, some of them also see investing as a hobby. So they try to spend a lot of time on that, but they forget, let's say, also the more rational part is that, is it worth my time? Is it a good investment? And do I have a system in place that accounts for my own mistakes?
Yeah. That's one. I mean, one of the things you mentioned is like people think they can be the, stock picking god or the best trader in the world. But on the other hand, there are a lot of people who I talk to who haven't started investing, right? They think about, oh, if I start investing, I have to read Financial Times every day. I have to analyze the chart and read the, reportings. I don't have enough time. That's what prevents people from even start investing. So what advice would you give it to average, let's say, professionals who have full-time job, who don't want to become, or think they can become the best trader in the world? How can you encourage them start investing and build wealth?
Yeah, so I would always say, keep it as simple as possible. If you need to look at your investments more than once a year, then you're doing something wrong. Then you probably have something that's either too risky, or that that you don't understand it completely, and you're, let's say, for instance, you invest in a broad index fund, then the chances of you going bankrupt are close to zero. Of course, there's volatility, but if you understand that markets, once a year go down, let's say -10%, you won't get scared. So you just can leave it be. You don't have to look at it. So simplicity is king. And even if people want to, let's say, add complexity, start simple. It's easier to have a system that starts simple and then build upon it than to create a very complex beast and don't know how to navigate it and make mistakes that are unnecessary. So start simple. And especially if you don't want to look at it every month, then don't create a system that's not necessary. And I think liquid markets are then an easiest, especially if, for instance, residential real estate does require you to buy the house, look at a house, bid on it, do the maintenances, stay away from those investments. If you don't want to spend the time and energy on it, you won't be happy. Just keep it simple. The equity market has made many people wealthy. But more importantly, it's very easy to understand. That's why it's a great way to get started. So simplicity is king.
Yeah. So simplicity is a king. And I have one line to add to that is to check out Money Principles YouTube channel and learn the basics about personal finance and investing. So thank you so much for being here, Yasser. Would you like to, so I just already mentioned your YouTube channel. Would you like to let the audience know, is there anywhere else on the internet they can follow you and, absorb more of your wisdom and help them to create either financial peace, financial independence, or generational wealth?
Yes, you can also follow me on Instagram at Money Principles. So you can find me on YouTube, find me on Instagram. You can also reach out via LinkedIn, whatever, if you have questions. Always happy to help and see if I can have something, an insight for you. But my YouTube channel is the best way to find more content. I post twice a week. Try to keep the videos as snappy and interesting as possible. The goal is to create more content from here on.
That's really amazing content. I personally, I watch his videos, so very easy to understand. Great content. Thank you so much for being here. Thank you so much for creating, great content on the on your YouTube channel and sharing your wisdom with us. I hope to have you again.
I hope so too. Yeah. Thank you, Yassi.
Join the Facebook group at Fast Track Podcast 1, or you can find us on Instagram, YouTube, and of course the homepage fasttrack.life. See you in the next episode.